Hey, what's up, guys? It's Ian. I'm back with another episode, and I am excited to have Chris on today. Another episode of how investing has helped your life in general. So I haven't given this segment an official name yet, but it's not out on any audio. It's just really just for our audience that is with us, and I like highlighting my friends. So, Chris, enough about me. Let's just introduce Chris. Chris Haddon, what's up, brother? How you doing?
What's up, man? Thanks for having me on. Glad to
Hell
be
yeah,
here.
I'm glad you joined us. We did interview Jason a couple weeks ago, who's your business partner, and we were talking a little bit about your company at Hard Money Bankers and kind of what you guys do, and ultimately how we kind of build a relationship. But I'd like to, obviously, me and Jason probably talk way more than me and you do. The same way me and Jason talk all the time, more than Dan and Jason talk.
Sure.
But just kind of your side of what you guys do, and kind of what your investing trajectory looks like.
Yeah, sure thing. So HMB, our lending company, we've been around 15, 16 years now, and we are a first mortgage lender on investment real estate, both residential and commercial. And that was our background, before we started HMB too. And it continues to be the majority of what we do. Like, we're a bridge lender on investment real estate. And it's a good business all around. Like, it's a pretty good cash flow machine. It has some drawbacks to it. And we're going to talk about, like how some of the investments we've done with you have like given us a good balance compared to our normal day-to-day business. One of the drawbacks is there isn't much of an opportunity for like bigger hits or windfalls. Like, it's more of like just hitting a lot of singles and doubles day in and day out on origination fees, on servicing fees, on investing in our own deals. And it's good for that, right? It's good. It's predictable. No complaints. Another kind of drawback is the way it's taxed. So everything that we are earning at HMB, whether it's through the fees or investing in our own notes, stuff like that, it's all taxed as ordinary income, right? And ordinary income is an expensive tax.
Very expensive tax.
So one of the cool things that came into play that, kind of addressed both of those issues that I was talking about was when we started doing equity deals with you. We had owned our own properties. We had owned residential rentals, managed our own portfolio, and we sold those off. Like, we bought in like 13 and 14 kind of time frame, sold them in like 2019 to 2021 kind of time frame, did well on the sales. Didn't want to own and operate the real estate ourselves, but we still want to be invested in real estate. There's important stuff that comes from that. Like, you can get a bigger hit from a sale or refinance on the right deal. You do get a K1 that has some depreciation, cancel out some of that other income we have, right? So being able to add that to our mix was, frankly, just a huge win for Jason and
I. Yeah, and we talked about when I talked with Jason the other week, guys. If you haven't seen that episode, I'll toss the link in here too. But we talked a lot about how we talked about working together and building that relationship. And honestly, I look up to you guys when it came to raising capital, but we all kind of do something similar. You have your capital investors and say, hey, you guys earn a bunch of money over here. Here's an alternative too. And then I would look at you guys and say, man, you guys are making all this money, but you have no tax benefits. Like, come and check this out because
Right.
I think I can help you. And then we invest in your deals, you invest in our deals, and it becomes a big circle. And having that vehicle, I think, is what's important, and knowing where to allocate capital for different buckets to do different things. Because just to kind of clear it up for anyone that doesn't know what they do is they borrow money from their capital investors and their own capital, and they put money into deals to fund more almost like a mortgage lender is the best way to view it.
Sure.
And where with us, it's more like, hey, I'm a partner with, and that was always the big hurdle early on was like, man, we're talking about single family houses, $300 a month to split. It doesn't make financial sense for any of us. Then we started doing some bigger deals. I feel like, I don't want to say it like this, but like you guys kind of noticed, and we started to have more and more conversations. What was your big hurdle? And it's almost like funny because I'm sure people ask you the same thing, but what was your big hurdle jumping in to say, hey man, like, I want to do this. We know that you're the right operator. We think that you have potential here. What was your guys' biggest holdback to allocating capital into one of the deals?
Yeah. So the only hurdle really was just, well, I'd say two things: comfort level, just the fact that it's not what we did day to day. And then two, getting a little bit of skill at underwriting an equity deal. Not a ton. Like we don't have to be a black belt at this, but we have to know what we're looking at because the deals that you do every day are very front of mind, right? And so if I'm thinking through a first mortgage loan on a piece of property, an acquisition loan, whatever it may be, it's very easy for me to do those numbers in my head. I know exactly how they work. I know what a first lien position is, like day in and day out, it's there. Equity investing was new. And it's not that I was unaware of it, it's just it wasn't what we were doing every day. So understanding you put X amount in for this kind of percentage ownership um, of the LP. And then also like you can new things like unit price, like how many units are you buying for stuff? Like there's
Right.
different ways that you can calculate your ownership and what is that going to look like? What does this look like on a spreadsheet? Who owns what? What's the pro forma? What are we looking to do like practically and exit wise, time frame, and just really getting a basic level of comfort with those deals. And that happened. And we, kind of worked through that pretty quickly. And then we did another one, another one, another one. And it's like, okay, now we got it. Now we understand this formula.
Yeah, I think that's the hardest part of any vehicle, right? Like when I look at your guys' vehicle, I'm like, oh man, like, well, what if the borrower doesn't pay? Like I'm like looking at it, go like, and we borrow money from you as a hard money borrower, and
Sure.
I'm even going, man, you guys do all these loans. Like, what if someone doesn't pay? Like, it's the same thing. And like getting that barrier to break down. And at a certain point, I feel like you just have to kind of do it, right? Like, and you got to dabble and try it out and just play around and say, okay, well, I put some money in and it worked and it goes from there. And I know you were talking about the equity and the equity pops. But the other thing is like that's the fun stuff. And I think this is where you guys as mortgage lenders and people with this personality type might say all they see is downside, downside, downside. Because you guys know your downside mitigation in your own business. It's a
Right.
foreclosure, and it is that done easy, simple. And most of the time, you're not going to wipe out equity. Luckily, we haven't experienced a big downside. I'm going to do a case study here on our one issue that hopefully turns into a positive with the property that burned down. But I mean, we broke
Mhm.
even and then some. So that's exciting. We took a bad thing and turned it into good. But would you say that not knowing that downside risk mitigation was an issue on how to handle that when you're underwriting these?
Yeah, for sure. Like we've been fortunate in that we haven't had many sideways deals. Like only things are, things perform differently than you expect, but not like sideways. You know what I
Right.
mean? And what would that look like from an equity position? Like, and of course, your buy numbers are super important. So like, even if you have to bail, you're going to be okay. Like in a deal like that.
Yeah.
Um, Plus, obviously there's other circumstances there. There's a fire, there's insurance. Um, yeah, I mean, buy price is important, and not only for reselling and flipping, but also just for risk mitigation, right? Um,
Yeah. Yeah. 100%. I know you guys do it in your business. We do it in our business, and we're all out here um, protecting capital investors, right? Because it is friends and
yep,
family. And guys, if it feels like I'm talking with Chris, like almost like I don't want to seem salesy, but like equal to because he's in the same business, and it's just interesting to see how our businesses compare as I'm going through this highlight study. Um, One question I want to ask you, you guys or yourself personally, where else do you invest? Like, obviously, you guys have a great investment vehicle. You have an investment vehicle with us. Do you do anything besides these two things to diversify your personal portfolio or your guys' company's portfolio?
yeah. So the pie chart, as I have it now, and as I see it growing into the future, is somewhat evenly split. It might not end up staying even, but somewhat evenly split between investing in our own hard money loans, right? Great bucket for us. We own it, we control it, good rate of return. Investing in commercial real estate in the LP setup, stuff that we're not operating. Maybe we'll end up buying a property we, own and operate ourselves in the future, but we'll see. And then also in standard kind of equities. We have a company level 401k that as the owners of the company, we can put a bunch of money into tax advantage type stuff. So obviously we do that, just very, very simple S&P 500 index investing. I have another portfolio that is also in low cost index fund type stuff. And then also kind of for fun, I buy individual stocks. It's not a huge part of, my assets. It's money that if I were to lose on it, no problem. And I'm not
Yep.
buying and selling. Like I'm buying and holding like, it's standard value investing, like a great company at a good price, buy it and sit on it.
Yep.
And I like doing that. And I like just out of my own entertainment, I like keeping an eye on the stock market. What's going on, this stock up, down, like the Dow, the S&P, like I just like having that stuff on my radar. I find it enjoyable. So that's the answer. Like if I'm pretty evenly split between those three in the pie chart, I think the assets are going to look pretty good down the road.
Yeah, no, it's a common theme with everybody that I've interviewed in this little segment is just they have a plan. They have a capital allocation plan to say X number of dollars is going here and there. And we tell all of our capital investors, please go buy real estate. Like if you want it in your portfolio, you should have it if you're comfortable doing it. And whatever you're comfortable, you should have money in the stock market. You should have diversification and continue to grow and go. What do you see for the future? I know you kind of alluded to it, but is there anything that I know you guys have done some venture deals? You guys plan on continuing to do some stuff like that, or I know you mentioned that you might buy a property. You guys got to have any predictions or anything that you want to do over the next 5 years?
Well, I would say not likely on any more venture deals. um, those just have such a high percentage chance of flopping, and we've seen it happen. And granted, we've gone into those with small bets for sure. We froze up.
You're good. It'll continue to record.
Okay, keep going.
Yep, you're good.
Okay. Yeah, we've placed small bets on, angel type stuff, startup venture kind of thing. It's too easy for those to flop. So probably not any more of those. Um, Definitely more of the same, pie chart that we are talking about, increasing those amounts that's going into assets, quarterly, yearly. And then we'll see. Aside from that, we'll see if we ended up purchasing something ourselves. Maybe we own or occupy office space. That's something an idea that we've tossed around. We'll see where it goes. But for now, like, if it ain't broke, don't fix it kind of thing.
Yep. That makes 100% sense. Yeah, dude, I appreciate you hopping on and talking about kind of what you guys got going on, and what you guys see fit. And, we've appreciated you guys being on board because it's been a good voice of confidence we're doing the right thing because you guys are in the business. And we've learned a lot of our capital raising and protecting investors and doing the right thing from you guys. I mean, I'm going to give you guys a shout out here. You guys have almost $50 million on the street, and you've taught us a lot on that. And honestly, it is personally an honor. And I know I could call you at any time, but I'm very glad that you hopped on here and to be transparent. So I appreciate that, man.
Absolutely. Happy to be on.
Oh, lost you. Well, I don't know what happened to Chris. Hopefully he hops back in. If not, guys, that was Chris Haddon from Hard Money Bankers. Like I said, I appreciate him and Jason so much. And if you guys have any questions or you want to learn more about what we do, feel free to click the link and we'll catch you guys on the next one.